All right, dear students, now we are going to start another important standard for your exam, which is revenue from contracts with customers. And this IFRS 15 is tested as part of the objective test case questions when you have objective test case questions, as well as the final account question. The final account question is where you're required to prepare the financial statements, the statement of profit or loss, and the statement of financial position. So in that question, this IFRS 15 comes as an adjustment, like there will be something regarding IFRS 15, for example. The revenue is recognized regarding the services which should not have been recognized. The revenue is recognized when it should not have been recognized, things like that. So the final account question. So you will be having the IFRS 15 in the objective test case questions as well as the final account question. Now, the first thing you need to understand within IFRS 15, which is very important again when it comes to the objective test case questions as well, is a difference between the income and the revenue. And this is a very, very common question in the interviews as well. So you need to know the difference between the income and the revenue. Now, when you're talking about the revenue, revenue is the income from the ordinary activity of the business. For example, I have a company which deals with the IT equipments. We sell the IT equipments. So the revenue is the income which is coming from the sale of those IT equipments. For example, I have a company which sell cars. Now the revenue is the income which is coming from the sale of the cars. Now, anything other than the ordinary activity of the business, any inflow other than the ordinary activity of the business is income. For example, when you talk about the income, it can be interest income. Now, interest income is not the revenue. Similarly, you talk about the dividend. For example, I have purchased shares of another company and I'm getting the dividend on those shares. Now, this is the dividend income which I'm getting. Now, this dividend income is the income, but not the revenue. Similarly, if I'm acting as an agent, like for example, my fellow company wants to buy something and they are asking me to help them in the procurement. And I say to them that I'll be charging 1% commission on those procurements. Now, this agency is not my ordinary activity of the business. I'm doing it one-off once in a blue moon. And I'll be charging those 1% commission on that. Now, this agency income, when you're acting as an agent, and similarly, when you are receiving the commissions, this agency fee and the commissions is recorded as income. It's not the revenue, unless and until your ordinary activity of is earning is having the agency or the commissions. For example, you are a real estate agent who help the people in buying and selling the properties and getting the rental properties. Now, in that case, when you get the commissions and the agency fee, that is your revenue because you are a real estate agent. But for example, you are helping someone and then you are charging a commission or the agency fee. In that case, it should be recorded as an income. So interest income, dividend income, agency fee, commissions, even the discount received, etc., all of these are the income, but not the revenue. So revenue is the income which is coming from the ordinary activity of the business. Say, for example, I'm selling the laptops. So the income which is coming from the sale of the laptop should be recorded as the revenue. Now, we do have the question in the FR paper in which the examiner says that you were acting as an agent and you have earned a commission of 10% or 20%. And that 10%, 20% commission is being recorded in the revenue. Now, well, in that case, you need to de-recognize it from the revenue. You need to reverse it from the revenue. And you're going to record it as the other income and not the revenue. So in the exam, you should be focused enough to deal with such type of questions that if you're acting as an agent or you're receiving a commissions, even sometimes, like the exceptions, the exclusion, sometimes the examiner says that you have sold a non-current asset and the proceeds have been recorded as the revenue. Now, you cannot record the proceeds as the revenue because the sale of the non-current asset is not the revenue. Only the gain or loss on the disposal of the non-current assets should be recorded in the profit or loss, and you cannot record the proceeds within the revenue. So if this is the case that the revenue is incorrectly recorded, then the examiner will expect you to remove it from the revenue, de-recognize it from the revenue, and record that thing as the other income. So this is the main difference between the income and the revenue. Now we'll be talking about the IFRS 15. Now, if you go few years back, this standard used to be IS 18, revenue recognition. But there were issues in that standard, like that standard were not having the provisions, not having the modern accounting treatments. Like nowadays, we are having so many issues which are specific to the current business world, and IS 18 was not able to cater those issues. And then there was another standard which used to be IS 11, construction contracts. So the construction contract, the accounting remains the same, everything is same, but that accounting is now part of IFRS 15. So they have made a new standard, and this new standard includes two previous standards. There used to be IS 18, which was the revenue recognition, and the IS 11. Now those two standards have been merged, and it is going to be in the new standard, which is IFRS 15, not something very new, something in the near past, a few years back. So the core principle of IFRS 15, revenue from the contracts with customers, that entity recognizes revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which an entity expects to be entitled in exchange for those goods and services. Now, the important point within this introduction is you're going to recognize the revenue when you're going to meet your promise regarding the transfer of goods or services. This is the first thing you need to understand. Like, for example, I'm running a business school and we have charged the students, we have taken the fee from them, and we have not yet provided them the classes. So that means the fee which we have received cannot be recognized as the revenue, as we are yet to meet our promise of giving them the services which are the educational services. So this is the first point you need to understand, that you're going to record the revenue when there is going to be a transfer of promised goods or service. That means you're going to meet your promise regarding the transfer of those goods and services. It can be goods or it can be services. For example, you're going to supply the inventory. So for example, if you have given them the control of the inventory, you're going to record the revenue. For example, if you have provided the services, you're going to record the revenue. So there should be a transfer of promised goods or services. Say, for example, it is yet to be fulfilled, then you cannot record the revenue. This is the first thing you need to understand. And the second thing is that you're going to record the revenue, and what is that amount? The amount that reflects the consideration in which the entity expects to be entitled in exchange for those goods and services. Now, why I am not saying that something which is mentioned within the contract, like for example, A did a contract with the B, and B is going to give certain amount to A, and this amount is being mentioned within the contract. Why I am not saying that it should be a contractual amount, contractually agreed amount that should be recorded as the revenue. Now, I am saying the entity expects to be entitled. Well, let's assume, I'm going to give you an example of that as well. Let's assume A contracted B, and B promised A that they will be giving them $100,000 against those services that will be provided by the A. B promised to give $1,000 to A against the services they are getting from the A. Now the A expects that the B is not in a position to pay the full amount, And the A expect that they will be getting around $900 from B. Because of the financial position of the B, A expects that they will be getting $900, or it can be any reason. For example, they think that once they have provided the services, B is going to create a problem and they are not going to pay the full amount, and they believe that they will be paying $900 maximum, and they are not going to receive that contractually agreed amount, which is $1,000. Now, at what amount the revenue should be recognized? Is it going to be $900 or $1,000? It is going to be $900 because the standard specifies this thing, that it should be an amount that reflects the consideration to which an entity expects to be entitled in exchange for those goods and services. So it is not going to be the contractually agreed amount. It is going to be the amount they expect to receive. Now, what they're going to do is they're going to debit the receivables by 900, and they're going to credit the revenue by 900. Now, you know the double entry, that when they're selling on credit, it is going to give rise to the receivable. Receivable is an asset. When asset increases, you're going to debit it. And obviously it's a sale, and we know that the principle of dead click, the income should be credited when it increases, so credit goes to the revenue. Now let's assume later on B were happy regarding those services and they paid complete 1,000. Now what are you going to do? You're receiving cash of 1,000, right? You're de-recognizing receivable of 900, which you created earlier. Now you see the debit credit is not same. You're receiving 1,000 cash and you're crediting the receivable of 900. Now what creates the difference? The difference is going to be recorded as the revenue. Now later on you can record the revenue of $100 as well. But initially, when you were expecting you will be getting $900, you're going to record 900 only. And if you receive 100 later, then you're going to record it later, but not at the inception of the contract, because at that time you were expecting to receive $900. Now, the important thing is that IFRS 15 describes the 5-step criteria to record the revenue. It's a 5-step model. And the mnemonic to learn, acronym to learn that 5-step is COPAR, C-O-P-A-R. C stands for the contract. O stands for the obligation. I'm going to describe it. P stands for the transaction price. A stands for the allocation. R stands for the recognition. So you're going to remember it through an acronym, which is COPAR. C means contract. O means obligations. P means price. A means allocation. R means recognition. So this is the 5-step model. Now, the first step is identifying the contract, although we'll be looking at the details within the slide, but let me just give you a brief introduction of this 5-step model, which is identify the contract means, now probably you have studied your law paper, which was F4, that there should be a legally binding agreement between the parties. There should be a legally binding agreement between the parties. Now, the legally binding agreement means, you know, the legally binding agreement is when you have the offer and acceptance thing. One party will be offering, other will be accepting, and the transaction price is mentioned within the contract, because we know the 3 elements essential for the contract is offer and acceptance, which is agreement, and then we have the consideration, which is the amount that should be mentioned within the contract. You know, I hope you remember from this thing from your law paper. The third thing was intention to create a legal relations. So identify the contract means there should be a legally binding agreement between the 2 parties. And then we have identify the separate performance obligations within the contract. Separate performance obligations within the contract. Now, let's assume you are enrolling yourself on my ACCA platform, which is MARFAT ACCA online. And let's assume you are paying for the financial reporting. And you're giving a particular fee, whatever it is, let's assume. And this fee includes the course videos. You will be getting the course videos, and you will be getting the study material, and you will be getting the tutor support. Let's assume you are enrolling for 6 month session, a tutor support for 6 months. And then there is the revision at the end of the course. Now, these are the 4 things within this course, and you're paying a lump sum amount for all these services. Now, you got the immediate access of the course videos. Fine. That means the entity has fulfilled their obligation regarding the course videos because they have provided you with the course videos. And now you can start watching those videos, and the entity has given you the access. The company has given you the access. The platform has given you the access. So their responsibility regarding the videos have been fulfilled. Their promise has been fulfilled. Now the study material, they immediately transferred you, sent you the study material. So their obligation regarding the study material has been fulfilled. Now the tutor support, when it is for 6 months, obviously that 6 months tutor support will be gradually provided every month. That tutor support cannot be provided immediately. Like I cannot say that the 6 month services can be provided in a single day. Obviously, it is not possible. So that means this performance obligation cannot be met immediately. It is going to be met gradually every month. Similarly, the revision is going to be at the end of the course. So we cannot provide the revision at the start of the course. That means this obligation, it needs to be fulfilled by the end of the course. So why we are studying that there are different components within the contract, there are different obligations within the contract. The idea is that you have received a lump sum amount from the student, and some services have been provided and some are yet to be provided. And do you remember the principle that what we have studied in the definition and the introduction of the IFRS 15? That you're going to record the revenue when there is a transfer of promised goods and services. So that is why it is quite important that if you are doing a contract and there are multiple performance obligations within the contract, you need to identify it separately because some may be met immediately and some may be met gradually over the time. So accordingly, revenue should be recorded immediately and over the time. The services which you have provided immediately, the revenue can be recorded immediately regarding those services. But the goods or services which you are yet to provide, you cannot record the revenue related to that. That's why there's a step number 2, identify the separate performance obligations within the contract. It can be anything. Like for example, you know that when you buy a phone from a company, that the telecommunication company, you know, they usually offer the phones alongside their services. For example, you're buying an iPhone. You're buying an iPhone 12, and alongside iPhone 12, you're getting their connection. In the connection, they will be giving you the services. They will be giving you the internet for a specific period of time. Now, they will give you the phone immediately. Obviously, it is not possible that they be giving you the phone within the piecemeal. Obviously, they're going to give you the phone immediately. But regarding the connection, for example, you are getting some free minutes every month. For example, you're getting particular data, internet data every month. Let's assume they contracted you to provide 5 GB every month for 2 years. Now, they're going to fulfill their performance obligation every month. They cannot provide you all the data related to 2 years within a single month, because this performance obligation will be met over the time rather than immediately at point in time. So this is why it is important to identify different performance obligation. There are many examples of it. We'll be dealing that in a while. The third step is determining the transaction price. Now, within the transaction price, there can be many things. There can be fixed consideration, the fixed amount you will be getting. It can be a variable consideration. Like for example, you're going to buy shirts from my textile company, and you're coming over there, and you're asking me what is the price of the shirt, and I say if you're going to buy 1,000 shirts, this is going to be the price. If your order is between 1,000 to 1,500, this is going to be the price. If your order is between 1,500 and 2,000, this is going to be the price per shirt. Now that means the concentration is variable. It is changing according to the orders. So there are many things within the consideration. It can be a fixed consideration. It can be a variable consideration. It can be a non-cash consideration. For example, you're not paying in cash. Instead, you're giving, for example, the shares. You're getting the shares in exchange. For example, someone getting the services from my company, and then they say we are not going to pay you the cash. Instead, we are going to give you the shares in their company. Now, if I'm getting the shares in exchange, how we are going to record the revenue? What value we are going to record the revenue? This is going to be dealt with in IFRS 15. Similarly, there can be considerations payable to a customer, a very important thing that we'll be doing later. So the step number 3 is determining the transaction price. Now the step number 4 is allocate the transaction price to different performance obligations within the contract. You see, we have charged the lump sum amount over here in this example. Now, I have provided the course videos immediately. Now, what amount we are going to allocate to the course videos, because we can record the revenue related to course videos because we have fulfilled our promise. Now, this is the lump sum amount for the complete package. How we are going to allocate the amount to the course videos? What amount am I going to allocate to the study material? Now, the simplest way to understand is using the standalone prices. What if I am only giving the course videos to someone? What amount do I charge for that? What if I'm only selling my study material? What amount do I charge for that? So that means based on the standalone price, you can easily compute the allocation. But again, there are some things within that, because when you are selling this as a package or a bundle, there's a discount involved in that, and that discount should be applied to the all performance obligations. We'll be doing an example of that as well. The last step is the recognize the revenue when the performance obligation is satisfied. That means when you have fulfilled the promise. So the promise can be fulfilled at point in time immediately. For example, I provide the course videos immediately. That now in that case, the performance obligation has been met and the revenue can be recorded immediately at point in time. And similarly, the tutor support is provided gradually. So once I have provided the tutor support for a single month, I can record the revenue related to that month. Now, there are 2 months which have been provided. 2 months can be recorded as the revenue. Similarly, so on. So when the performance obligation is satisfied, is fulfilled, the promise has been fulfilled, the revenue can be recorded. So this is recognize the revenue when the performance obligation is satisfied. So now we have the step number 1. Step number 1 is identify the contract with the customer. And I've told you that this is, sorry, this is some knowledge which you have studied in your F4 exam, that there should be a legally binding agreement within the contract. It can be a written agreement, a verbal agreement, an oral agreement. It can be anything. Because we know the 3 essential elements of the contract is offer and acceptance, and the consideration and intention to create legal relation. And the contract can be written, even it can be a verbal contract. So the parties have approved the contract. That means an agreement, offer, and acceptance. The entity can identify each party's rights. Now, for example, I'm going to provide the services. My obligation is providing the services. Their right is to get the service. My right is to get the money for it. So the entity can identify each party's rights from the contracts. Everything is mentioned. The entity can identify the payment terms. The contract has a commercial substance. That means the economic reality. There should be an economic reality of the contract, which includes the risk and rewards, the timings, the amount of cash flows it is going to be generated. It is not going to be, something gambling. It's not a gambling contract. That something is not happening. Something is not happening. And like, for example, you say, I'm going to buy the gold at this much amount, and you're not actually buying the gold, and you are just playing with the amount of it. Now, this is not something which can be related to the commercial substance. So there's not economic reality of the contracts. The contracts should have a commercial substance. That means there should be a risk and reward thing. There should be a timing of it. There should be the amount of cash flows which are going to flow to the entity. All the things are that. And the last thing is, it is probable that it will collect the consideration. I've told you that this was the amount that the entity expects to get in exchange. So that means if you think that you are not going to get any amount because the customer is not in a position to pay, then you are not allowed to record the revenue as well. Like previously, there used to be a case in the IS 18 that you were recognizing the revenue. And for example, when the customer is not paying, then you were recording it as a bad debt. Now, the thing is, the IFRS 15 has changed this principle that if from the very start at the inception of the contract, you think you won't be getting any amount from the customer, then you are not going to record the revenue. So this is the provision within the IFRS 15 that it is probable that the entity will collect the consideration. That means the customer ability and intention to pay that amount of consideration when it is due. And when you think that at the start of the contract, the customer won't be paying you anything, then you will not be recording any amount within the contract. So the example, a vendor sells 1,000 units of a product to a customer in return for a contractually agreed amount of 1 million. This is the vendor's first sale to a customer in the geographic region, and the region is experiencing significant economic difficulties. The vendor believes that the economic condition will improve in the future and that by establishing a trading relationship with the customer, sales volume in future will be enhanced. Like they're selling them something and currently they're having the economic issues, economic problems, economic recessions, and they believe that things will get over in future. These economic recession will get over in the future, and then they will be having a good relationship with that vendor, that customer. However, for this first contract, the vendor does not expect that the customer will be able to pay the full amount of the contractually agreed price because they're having this financial issues, economic difficulties. Consequently, the vendor determines that it expects to offer a 50% discount to its customer. Now, at the start of the contract, at the inception of the contract, they believe that the customer won't be able to pay the full amount. And at the inception of the contract, they're offering them the 50% discount. Now, this is something, this is something to build a good relationship with that customer, that in future, when they will be having the good times, they will be buying something from us. So at what amount the revenue should be recognized? The revenue should be recognized at 5 lakh because you cannot record complete 10 lakh, 1 million, because you're offering 50% discount. So 5 lakh 500,000 should be recorded as the revenue. So if the other 4 criteria set above are met, the contract for the sale of 100,000 units returned for estimated consideration is accounted for within IFRS 15 and the revenue should be recognized at 500,000. There's another example. Eluna has a year end of 31st December 20x1. On 30th September 20x1, Eluna signed a contract with the customer to provide them with an asset on 31st December 20x1. So they are signing a contract on 30th September 20x1 to provide an asset on 31st December 20x1. Control over the asset passed to the customer on 31st December. The customer will pay 1 million on 30th June 20x2. By 31st December 20x1, as a result of the changes in the economic climate, Eluna did not believe that it was probable that it would collect the consideration that it was entitled to. Therefore, the contract cannot be accounted for and no revenue should be recognized because they believe they won't be getting any amount for it. So they do not expect to get any amount from it, so they cannot record the revenue at the year end because they believe there will be no inflows to the entity. As we have studied, that it is probable that the entity will collect the consideration. So it is not probable here in this example. They will be getting any amount, so no revenue should be recognized. Now we have the step number 2, which is identifying the separate performance obligations within the contract. And I've already given you some examples of that. That if you're doing a contract and within the contract there are multiple obligations, then you need to identify those performance obligations, because some of them may be met immediately and some of them may be met later on. So that means you are going to identify those separate performance obligations within the contract. It can be anything. I'm going to give you some examples, more examples as well. At the inception of the contract, supplier must determine whether the contract is for a sale of single deliverable. That single deliverable means only one thing you're going to provide. It can be one service or goods, or several deliverables, such as I've given an example of the courses and the revisions and the tutor support. This is important as the revenue is recognized as these separate goods and services are delivered to the customer. Like, you cannot record the amount immediately because some of them may be met immediately and some of them are going to met later on. So these are few examples, very good examples to understand the concept of the separate performance obligations. Now, a vendor enters into a contract with a customer to supply a license for a standard off-the-shelf software package, install the software, and to provide unspecified software updates and technical support for a period of 2 years. The vendor sells the license and the technical support separately, and the installation service is routinely provided by a number of other unrelated vendors. The software will remain functional without the software updates and the technical support. Now, they are providing the software services, so giving the software, installing the software, providing them the updates, and giving the technical support as well. The vendor sells the license and technical support separately, that you can get the software and the technical support separately as well. Like, if you have purchased the software from someone else, you can get the technical support from this company as well. And you can only get the software as well. And installation can be done from other vendors as well. And the software will remain functional even if you are not getting any updates of the technical support as well. Now, the point is that the customer can benefit from the services on their own. The software is delivered separately from other goods and services, can be installed by a different third party, and remains functional without the software updates and technical support. Therefore, it is concluded that the customer can benefit from each of the goods and services either on their own or together with other goods or services that are readily available. This is the important point that you need to understand. The customer can benefit on their own or together with other goods or services that are readily available. If they're just getting the software, they can install it from somewhere else. They can even run the software without doing the updates, and they don't even need the technical support for the functionality of the software. So in addition, each of the promises to transfer goods or services separately identifiable. Because the installation services does not significantly modify or customize the software, the installation and software are separate outputs. So that means these are all separate performance obligations. Software is a different performance obligation. Installation service is a different, because it can be taken from other vendors as well. Without software updates, you can run the software. So if you're getting the software update service as well, this is another separate performance obligation. And even without the technical support, you can run your software. So if you are taking the technical support, that is going to be another separate performance obligations. So that means these are the 4 separate performance obligations within a single contract. Because you can get only the software and make it install from somewhere else. The software is functional even without the updates and even without the technical support. So these 4 are the separate performance obligations. Now, the same example, and there's a modification in that, and you need to understand that. The vendor contract with its customer is the same as in the scenario A, which we have studied in the previous slide. Except that as part of the installation service, the software is to be substantially customized in order to add significant new functionality to enable the software to interface with other software already being used by the customer. That if you buy the software, you need to sync it with your existing softwares. And you need to get it installed by the same vendor, because you need to customize it with, you need to integrate it, you need to sync it with your existing softwares. The customized installation service can be provided by the number of unrelated vendors, but usually when you're buying a software and you need the customization and integration and syncing, the same vendor is going to install it for you. So that means the software license, the software and the installation is now a single performance obligation, because you're going to get it together. You are not going to get software alone because you need the customization. And the software update, you can run the software by yourself without updates, and there is no requirement of the technical support. So the software updates and technical support are again separate performance obligation. Now, why we have merged software installation service in example B? Because the business was looking for the customization, syncing, and the integration. Now we have the software scenario C, the example C. The vendor's contract with its customer is the same as in the scenario B, except that the vendor is the only supplier that is capable of carrying out the customized installation service. In that case, there is no option. The software updates and technical support are essential to ensure that the software continues to operate satisfactorily. Now, there's no option to run the software without technical support and updates. That is essential as well. And the customers, employees continue to be able to operate the related IT systems. No other entity is capable of providing the software updates and technical support. In that case, all of these 4 performance obligation is a single obligation. In this case, the analysis required by IFRS 15 indicates that in the context of its contract with the customer, a promise is to transfer a combined service. And this combined service is a single performance obligation. All of that, because the software needs the installation. You cannot install it from somewhere else. It also requires the updates and technical support. Without that, the software cannot function. So that means it's a single performance obligation. So this is something very important to understand, that how many different performance obligations within the contract the entity is going to have. So at the inception of the contract, a supplier must determine whether the contract is for a sale of single deliverable or several deliverables, because all of them are going to be met within the different time period. And in that case, the revenue should be recognized accordingly. So you need to see which of them are going to be met at point in time immediately and which are going to be met later on over the time. So the revenue is recorded accordingly. Now we have the step number 3, which is determining the transaction price of the contract. And I told you that the transaction price may have multiple components. For example, it can be a variable consideration, the existence of the significant financing component. And the financing component is, for example, you're entering into a contract. Let's assume I'm going to enter with in the contract with the government. And the government says, okay, we are going to pay you after 2 years when the project is completed. We are not going to pay you in advance. But it's a good amount of money I'll be getting for the government. And plus, because it's for the government, I feel secure that, okay, there's no chance of bad debt. I will be getting the amount even after 2 years. So what amount of the revenue should be recognized now? The standard says that if you are going to get the payment in the future, today you're going to calculate the present value of it. The present value should be recorded as the revenue, and the same unwinding concept which we have studied in other standards will be applied over here, that you're going to bring the amounts to the present value and then systematically you're going to unwind it. And then we have the non-cash considerations. For example, you're giving the services, in exchange you're getting something non-cash, for example, the shares. Consideration payable to a customer. This is something very important. I'll be discussing it when we have the relevant slide. Now, there is one more important thing, which is right to return. If a product is sold with the right to return, then the consideration is variable. Usually, the businesses are doing this in order to enhance the confidence of the customers. The entity must estimate the variable consideration and decide whether or not to include it in the transaction price. The refund liability should equal the consideration received that the entity does not expect to be entitled to. Let's do an example and then you will get the point. Nardon enters into 50 contracts with customers. Each contract includes the sale of one product for $1,000. The cost to Nardon of each product is $400. Cash is received upfront and in advance, and the control of the product transfers on delivery. Customers can return the product within 30 days to receive a full refund. If you're not going to like it anyways, you can get your refund. Nardon can sell the returned products at a profit. Like one customer is returning, you can sell it to another customer. Nardon has significant experience in estimating returns for this product based on their past figures. It estimates that 48 products will not be returned. This is their best estimate. That when they are selling 50 products, 48 out of them are not going to be returned, and 2 of them are going to be returned. Now, how much amount they are getting? Debit cash, 50 into $1,000. They are getting 50,000. Now, how much they expect that won't be returned? 48 out of 50 won't be returned. So they can record the revenue related to that, which is 48,000. Now, what about the rest? The remaining 2,000. The remaining 2,000 should be recorded as a liability. So the fact that the customer can return the product means that the consideration is variable. Using an expected value method, that means using the best estimate, the revenue of 48,000 should be recorded, and the other credit entry, which is for the remaining 2,000, is your refund liability. Now, for example, if all of them are not returned, let's assume if not returned, in that case, you're going to de-recognize the refund liability, debit refund liability, and credit revenue if not returned. So Nardon will de-recognize the inventory transferred to its customer. However, it should recognize, now this is something very important point. This paragraph is important. This will clear you another concept. Nardon will de-recognize the inventory transferred to its customers because they have given the control to them on the disposal. However, it should recognize as an asset of 200 as well as a corresponding credit to the cost of sales for its right to recover products from customers on settling the refund liability. That simply means, for example, when you will be getting the inventory back, obviously you need to record it again within the statement of financial position. And we know that inventory is recorded at lower of cost or NRV. So when they will be getting their inventory back, that inventory will cost them $400. So 400 multiplied by 2, 800 is the right they will be getting their inventory back, which should be recorded as a credit to the cost of sales for its right to recover products from customers on settling the refund liability. Okay, so we have the financing component. Now, the financing component is simply if you are going to receive the amount in the future, the standard says you're going to calculate the present value of it. Example, Rude enters into a contract with a customer to sell equipment on 31st December 20X1 Control of the equipment transfers to the customer on that date. The price stated in the contract is 1 million and is due on 31st December 20x3, that they will be getting the amount after 2 years. Market rates of interest available to this particular customer are 10%. Now, you can simply calculate the present value. Present value equals to future value, 1 plus r raised to power minus n. R represents the rate of interest and n is the number of years. So when you're going to apply the formula, you're going to get 8,26,446. This is the amount that you're going to recognize within the revenue. Now we have the non-cash considerations. Non-cash consideration, maybe you're getting the shares in exchange. So usually whatever it is, usually it is recorded at the fair value. For example, you're getting the shares in exchange, take the fair value of those shares and record that thing as revenue. In some cases, the customer might pay for the goods or services in the form of non-cash assets. So you are going to deal with this non-cash transaction by just looking at the fair value of those items which you are getting in exchange. If it is not possible to measure the fair value, that means the market value, then the vendor is required to estimate this by using the standalone selling prices of those goods or services subject to the contract. The standalone prices means the thing you're providing to them, at what amount you usually provide it to the other customers when you provide those things separately. Another example, Dan sells a good to Stan. Control over the good is transferred on 1st January. The consideration received by Dan is 1,000 shares in Stan with the fair value of $4 each. By 31st December, the shares in Stan have a fair value of $5 each. How much revenue should be recognized from this transaction within the financial statement? Now, I told you that if you're getting a non-cash thing within the exchange, just deal with it at the fair value. So how many shares you're getting? You're getting 1,000 shares. So revenue should be credited by 1,000 shares multiplied by its fair value at that date, which is $4. So you're going to record credit revenue by $4,000 and debit the financial asset. Shares are the financial asset. When you are having the shares of another company, this is an asset for you, and this asset is known as the financial asset. You're going to debit the financial asset at 4,000 and credit the revenue at 4,000. Now they're saying that by the year end, the fair value of the share is $5. Now, if you are still having those shares and the value has risen, then what you're going to do, debit financial asset by how much? Now the fair value is 5. So there's an increase in 1,000, and credit profit or loss. This is the gain you will be recording within the profit or loss, but revenue figure will not be affected. The revenue figure will represent the fair value at the transaction date. Once you got the shares, then if there's any movement within those financial assets, that should be reported to the profit or loss, and the revenue figure will not be affected. So this is something very important to understand, that the revenue should be recorded at $4, which is the fair value at the transaction date. Now you got the shares, this is your asset. If there's any movement within the shares and you're still having the shares, that movement should be shown within the profit or loss, and no movement should be shown within the revenue.